And this is not only beneficial to the children and their parents in the short term, but we know from many studies that when poverty is reduced for children, it redounds to their benefit over the remainder of their lives.
Thank you. I yield back.
Thank you. There are several votes on the floor. The committee stands in recess until immediately after the conclusion of this vote series.
Good. All right, long story short, you will receive a tax credit. A tax credit. What does that mean?
As for tonight, a pretty crowded calendar. We talked about Amazon, and we'll keep our eye on consensus expectations for AWS. I think is around 13, but we'll get Mondelez and AMD and Pins and some others.
What?
Yep, and then heading into a Fed meeting tomorrow, where of course
See if I raised by person. Well, of course. Who said?
report on Friday. It's a big week.
Yeah, and we're in the thick of it now. Let's get to the
Nobody said that at Harvard staff. By Harvard, the U.S. flag was already taken down prior to the incident due to the flags flying Monday. Okay. Who gives a shit? Okay, who cares? So, tax credits. Alright, tax credits. Once again, going back to, if you have to owe, like, taxes, and you're like, oh, they're like, oh, okay. You don't, well, we see you're a little poor peasant here. You don't make that much money. We could give you a credit if you'd like to spend more money on this thing, right? Them telling you and us and me, we the people, what dictates a tax credit. It has to be a tax credit that is already outlined what the tax credit is. You have a business, you want to go market it. If that's not in there, but a brand new electric car, a new battery that they're so worried about, like, so sad, bro. So yeah, tax credits. And who's to say that you even want that credit? Like, it's unreal. I don't know. Just going, like I said, it just all goes back to when I tell you guys they're not your friends. They prove my point day in and day out. They're not. They're not your friend. All right, let's go to the markets. It's lunchtime right now. So I guess I'm going to take a little, maybe, take a little time out here and maybe find something to eat. Maybe step outside, get some sun. So the electric went out. There was a guy working over yonder. So I'm not sure if there was because of an accident or they were just working on the power lines. So I heard the neighborhood pump behind me, the pump station kick on. So yeah. I don't really have much today that I'm like I don't really know. I haven't found any like relative strength, relative like I don't weakness. Really know. I haven't found type of names. We can look at some of the earnings ones and see what they're doing today. So we had PayPal, Lily. I seen that. Let's go look at them. Let's go look at it. Now, see, look. Again, I got to reset all of this because everything was just shut off. It's all good. Dude, what is going on here? I'm going to turn CNBC on. Sorry for getting upset with that, but it just really is upsetting. It's just upsetting to hear people say things that just aren't true. And when the government is pointing their finger at these big businesses that actually hire people, that give people the opportunity that, in other words, they would not have if it wasn't for that business. Do you know how many millionaires were made with Tesla? Do you know how many millionaires? Do you know how many weddings? Do you know how many retirement homes beach houses. Do you understand just what Apple and Microsoft have done for families? Right? But yet they're the enemy. Right? When if you were to listen to that like all the way through, you would notice one thing in common. The Democrats pointed fingers at big business. And they looked upon them as being the enemy that should be penalized for doing the good things that it has done. They want to know why the labor market is so tight. They point all these things out. Well, guess what? All that happened under the current tax code. So, I mean, you can't be as to blind to think that that does not help out at all. It does. You know, and then it's just if you think that telling companies that they can only get tax credits for doing electrical vehicle things and batteries, like what kind of horse shit is this? Like, what are we doing? I really don't understand it. And it's a lie that they say if you make under 400,000, your taxes won't be increased. Well, if you raise capital gains, there's going to be a hell of a lot of people out there that are going to get hit and pay more taxes, and they make under 400,000. You know, so that's a lie. That is a lie. I don't know why I got back on that subject, but I was just wanting to say, if it ain't broke, don't fix it. And it's just sad that they are looked at as the enemy and not for what it is that they are, and that is what has helped the United States become the United States. Right? You would not have the army and the military without the innovation from these companies. Like, don't get it twisted. The reason we are who we are is not because of the military. That military, first off, would not be there without the companies that we have. We have the greatest companies in the world, which has secondly handed, you know, enabled us to have the strongest military in the world, because we have the biggest business, right? We have more revenue. We got to do a lot of business across seas. Yeah, it's just the innovation. I don't know. It's just crazy. It really is. It's fucking sick, and I hate them. I really do. I honestly have not disliked an administration as much as I do this one. And they'll lie in front of your face. It doesn't affect you. First off, it doesn't matter if it affects me or not. Thirdly, it will affect me. And when they tell you, when goofballs that vote for Biden say it won't affect you, if this goes through, it's going to affect me. I'll tell you that right now. Fucking idiots. I personally would be in favor to not change it.
Hang on a second. Hang on a second. No one's calling for it, but it obviously is.
Okay, so let's go. We'll go through the markets real quick.
Numbers like you did, you get a stock market reaction like you have. Employment cost index goes up, rates back up, then you get a couple of economic reads that are ugly. And
Guys, don't be surprised if we see a 504. Don't be surprised.
If the market really believed that stagflation is coming later this year narrative,
I think yesterday's close was a big tell sign of what happened and the type of day we may have. the first pop we can get back into like any of this and any of these levels here. Let's see what happens here. I'm gonna take a short. I might take a short. See, I feel like I'm trading a trade, so maybe I'll just go ahead and take the long here. Let's go. Let me go back. Oh man, I should not have ate those. I should not have ate that.
Job in terms of cost cutting and the fulfillment center build out is done. So I think it is going to be, and oh, by the way, advertising I also think is going to be an upside surprise as well. Again, I just think the expectations are super high. I trimmed a little bit last couple of weeks. I would be more than happy to be buying it back if it's weak.
Josh, you also have, these, and I think Meta is kind of caught in the same thing of these AI aspirations versus cost cutting, right? Meta stock performance, they learned the hard way. When you condition a marketplace that you've gotten over your excessive spending, or at least large amounts of it, and then you come back, even if it's for something as believable as investors believe in AI, you sort of take a pause. And I wonder what the impact might be on Amazon if they come out and say, well, our cost cutting's got to take a back seat for a minute because we need to ramp. We need to spend on AI because that's the next growth area.
So I think Amazon is a different animal from Meta. I get your point, but I think Amazon is a different animal from Meta because a lot of the AI quote unquote spending that's taking place is being spent with Amazon. So that's, by the way, there's a reason why the numbers are creeping up, and that reason is both Microsoft and Google had their cloud sales accelerate last quarter versus the sequentially prior quarter. So, it's not like out of the blue, all of a sudden everyone's excited. It's unlikely that you saw the acceleration you saw at the other two and not at AWS, which is arguably one of the better of the three, or of the, let's say, the five biggest cloud platforms. I think, though, also part of the story here is that, this is a stock where they have, first of all, it's the only $1 trillion company that doesn't pay a dividend yet. So we'll see if there's going to be a capital return story here. I think there might be. That's number one. Number two, the advertising business here is also growing as fast or faster than the cloud business. So I don't think the focus has to just be what's the AWS number, and then we just trade off of that. This is now the third biggest advertising business in the country. And again, that is a growth business for Amazon. And then the cost-cutting story. you talk about like, is Meta spending too much? Is the street all of a sudden more focused on, well, where are the profits from AI, et cetera, et cetera? As Stephanie and I have talked about for a long time, Amazon has had tons of room to cut excess spending from all different areas of the business. And so I think if they give guidance there, that effort continues, that also should be good enough for the street tonight.
Jimmy, sales are expected at a record, but Steph pointed to the year-to-date move in the stock. It's also up more than 70% in the past year.
Yeah.
Is that an asset or a liability?
It depends on how you look at it. The way I look at it is if you go back the last 3.5 years, it's basically flat. I mean, it was August of 2020 that it first reached the level that it's at right now. And it's had some sharp moves up and down in those 3.5 years. It recently actually broke out to a new all-time high. I think we all marked that on the show. That was about 2 weeks ago. Yeah, it did.
Yes, I said we did.
Sorry, yeah. And look, it pulled back with the market the last couple of weeks. Pulled back with the market the last couple of weeks, but it really seems to me like it's set up for a breakout to higher levels. The overall performance of the company is startling. I'm looking on FactSet right now, just at net income, right? I mean, that's what we own stocks for, is their net income. Net income has tripled at this company over the last 5 years. And, of those 5 years, 3.5 years, the stock's done nothing. I'm pretty comfortable owning Amazon right here. I think of all the large cap techs, this is the one that's probably the most positioned, even after Microsoft and Google, to outperform in its earnings.
The other one that's tonight, too, is AMD, right? Not to be forgotten about, because it's important. Josh, I'm going to get your take on it in a second because you have recent ownership in it. I know you don't have it anymore, but Christina Partsenevelos is sitting at the desk with us today here at Post 9 because you cover this. And, how should we think about this in an environment where it's so dramatically underperformed some of these other bigger names?
Yeah, especially the stock in just the last month. There's been a pullback of almost 15%. I think the concern with AMD is that you still have part of its business that is cyclical in nature. It is exposed to PCs, 20% of revenue. It is exposed to to more traditional servers. And we know from Intel, TSMC, a list of others, ASML, they've all talked about weakness in the first Q1 and Q2, and then improvement in the second half. So that is not necessarily good news for AMD, which is why we're going to be looking for any type of trends on those two categories. But on the flip side, all of this talk about CapEx spend, the AI chip, their MI300, more specifically the MI300X, they had previously said the full year 2024 estimate was going to be $3.5 billion. I say this because that number is extremely important. If they increase that estimate to about $5 billion, which is what the street is anticipating, then you'll see shares react very positively. Buy side even has that number as high as $8 billion. So that's the commentary that we're going to be looking for specifically with this MI300 series AI chip that is going to be the competitor to NVIDIA's H100, H200.
What's the easiest answer for why the stock has underperformed these other names so dramatically? Well, whether it's a Broadcom, which is up 20% year to date, right? AMD's only up 9%. Okay, let's just put that on the table. NVIDIA, for example, top of the heap, up 76%. Why is it?
You're describing AI plays versus those that are not necessarily solely AI plays. More than 50% of AMD's business comes from embedded, gaming, PCs, and those don't necessarily benefit from this big AI boom.
Yeah, but they've made it pretty clear that they're coming, right?
That the improvement's coming in those segments is what you're asking.
Yeah, on
yeah,
AI.
in the second half.
Well, so some of these other companies are getting the benefit of the doubt.
But Broadcom and Marvell are specifically for custom AI chips, and so they're actually benefiting in the near term. Broadcom, for example, has the collaboration with Google, so there's that difference, which is why they're seeing a bigger upside right now versus AMD that is still exposed to the cyclical nature of the chip space.
All right, they need to talk about AI like 3,000 times.
Well, yeah, I wonder. There's AI fatigue to a certain point now, where some investors like we're not seeing the actual monetization. I know this goes into greater tech as a whole, but there's only so much you can say AI and say that it's going to bring in revenues, and then it doesn't.
You still, Steph, prefer the Broadcoms and the Lambs to the AMDs?
Yeah, I mean, actually, I trimmed both a couple of weeks ago. I would buy Lam Research right back. After the quarter last week, it was very good. They raised wafer fab equipment spend again. This is the third quarter in a row. Gross margins are structurally higher than prior cycles, so they're much more profitable. And actually, I think that they do have an AI component to it. We've talked about memory needing 6 times, AI being memory 6 times. You need 6 times as much memory for AI. So, and this is a memory player. So to me, this is one I want to own. It's not down enough, but if we get a couple of days like today, because it's not so pretty, I might buy it back.
Josh, you sold AMD, as I mentioned. few months back?
Yeah, to answer your question, my opinion is like, why does it look like this? By the way, right in the middle of the pack, if you rank it versus the other semis, it's up about 9% year to date, but it's the 12th best performer out of 26 names in the SMH ETF. So it's not bad, it's just not great. But to answer your question as to why, I think the bar is too high. Expectations have gone up a lot. I think they can deliver, but it's not enough to deliver. You have to deliver and shock people to the upside. That's like the environment that we're in. The stock's trading 300 times earnings, 44 times forward, fine, cheaper, LOL. Analysts are looking for 2.3 billion in data center revenue for this quarter. To put that into context, they did 1.3 billion last year. So analysts are looking for $1 billion in incremental spend in that category year over year. I think they can do it, but like, is that going to be enough? So 20 cents in earnings, up from a loss of 9 cents last year. Again, the bar is super high here. So that's why I think it looks the way it does. Technically, the stock is in no man's land. I get interested in it if it falls after earnings. I agree with Stephanie. I love the name. I just don't want to pay for it where it is, and I don't like the sloppiness of the chart.
Ben, I'll give you the last word, Christina. I mean, this has been a darling over the last couple of years. Clearly, until the AI story sort of took over everything. And now you find out the winners from the losers, at least in the near term, apparently.
Yeah, and
not as a loser, but you know what I mean.
Yeah,
the winners from the just astronomical.
So the first mover
winners.
advantage of NVIDIA, of the likes of those custom chip makers you mentioned, Marvell, Broadcom, even the memory makers too, because they benefit from the high bandwidth memory that is needed in a lot of these AI chips. Specifically, AMD doesn't produce that. So even Samsung's results earlier this morning prove that. And so these are benefits for Micron, et cetera, SK Hynix, not necessarily AMD at the moment, unless they blow it out of the water right now at their data center forecast for the MI300.
All right, thanks for the setup. Appreciate it, Christina Partsinevelos. Speaking of setups, it's interesting, coming off the week we just had, I said the best week for the S&P since November. You did have people apparently getting more bullish because you've had, according to Bank of America's equity client flows, the biggest equity inflow in some 8 weeks. What are we buying? What are their clients buying? Staples, high on the list. Speaking of, Stephanie Link's new buy, a fresh buy. P&G.
A fresh buy, right? We talked about it last week. I own no Staples, so I was looking for one. And when I saw this quarter, it was actually very good. Organic growth of 7%, sales up 4%, gross margins up 300 basis points. I mean, that is just amazing. It's productivity, it's pricing. I like their product set. So it's not cheap by any means, but I just think that this is a really solid story, and it's kind of a defensive position to offset some of the more cyclical stuff that I have.
I'm glad you used the word defensive because that's sort of where I was going off of this buy, and I wonder stocks outlook and the risks. The respondents on the Fed survey that Steve Leisman does says that stocks have largely put in gains for the year. So maybe buying some Staples positions fits perfectly with that as we bring our senior economics reporter, Steve Leisman, into the conversation as we begin the Fed meeting. We get the decision, of course, in the news conference tomorrow, as we know that things have taken a more hawkish turn, Steve.
Yeah, they've begun to dial out rate cuts this year, Scott, along with the futures market, but maybe a little bit more hawkish than the futures market's done, Scott. A couple things in this survey. The only 50% or greater month for a rate cut is actually December now. They're 48 in September. So they have an average of 1.6 cuts dialed in. And you can see here what you're looking at is something different, Scott. That is the actual futures market. And that's come off a lot from this morning's ECI index. Market has, price-wise, thrown out June, thrown out July, and now pretty much working on throwing out September, which is in line with our forecast, Scott, at that 50% range. So it's really up in the air now, a jump ball. I don't know what you want to call it, as to whether or not there's 1 or 2 cuts this year and whether or not there's any at all. Because the other thing, they did move cuts into 2025. So we do have that in front of us. And that's when the 29 respondents better returns for the stock market is in 2025. So that might be a story for there. But they also raised the neutral rate, which brings up this idea of how tight the Fed is. And one of the things we're on the edge of our seat about tomorrow, Scott, is does Powell introduce a little bit more two-sided risk to the direction of rates?
Well, look, I'm sure tomorrow during the news conference that somebody in the room is going to end up asking a question to the chair regarding stagflation. And I'm curious as to how you're thinking about how they're thinking about that fear at this point.
You know, Scott, I'm sort of curious as to why stagflation has become such a go-to possibility. As I look back on the history, Scott, I think we've had one bout of stagflation in like 50 years. For stagflation to happen, something has to go wrong. The price mechanism has to be on the fritz, in the sense that if you have the stag part of this, in other words, no growth or even negative growth, then the normal result is that prices should begin to ease, or inflation should begin to ease. That's what you would expect. That's normally what happens. You have one bout, the 1980s, I believe it was, early 80s, when you had no growth and high inflation, and that was maybe because of the idea of what was happening with oil prices and the cartel jacking up and keeping oil prices high. Inflation expectations got out of control, bad monetary policy. Stagflation is an outlier of a possibility. The more poignant conversation, or the more likely conversation, is one of, do we have a recession, and is that recession what is needed to bring down prices to the Fed's target? That's really where the conversation, I think, is the more sort of odds-on probable conversation.
Well, and let's just pick up quickly where you just left off, because you said something yesterday that really stuck with me, and you alluded to it just now. The idea that when we started this whole thing, the Fed thought it had to crush demand and raise unemployment to get inflation under control. Right. Then inflation started dropping precipitously while growth remained strong. And then it pivoted to the conversation about, hey, let's not break what we don't really have to break. We can still get inflation down, and we can keep the economy strong. You said something yesterday, though, to the effect of maybe we're coming back to where we were before, where the Fed survey showed that the Fed need to now do more that they figured they didn't have to do to get inflation down to target.
Yeah, I mean, welcome to Act 3, Scott, of the endless play of the economy that we're in here. Act 2 was the idea that it didn't come to fruition, and Act 3 may be the rekindling of that. We have in our survey, Scott, 50% of respondents think that you need both below potential growth and a higher unemployment rate of a half a point or higher in order to get to the Fed's 2% target. Now, if you don't have those, can you count on more supply side improvement? Well, you know, Larry Summers has a tweet out I want to read to you, Scott, that just came out a few minutes ago, where he said the Federal Reserve's in a treacherous environment, should have been more careful about easing signals, and now should be very cautious about possible rate cutting. Now, Larry's not saying they're introducing this two-sided risk, but I am talking to some people who think that the Fed ought to put the market on notice that a cut is not a given for the next move for the Federal Reserve.
Interesting. Steve, thanks. See much of you over the next couple of days. Look forward to that, Steve Leisman. Up next, more moves from Steph in her portfolio, just adding to 2 key positions. Break them down when we come back. Plus, spin-off success stories, why big breakups have been a big win for investors. I'm going to show you our chart of the day. Pretty interesting story next.
GE.com.
All right, welcome back. We have some committee stocks on the move today. GE Healthcare, on pace for its worst day ever. Sorry.
No.
Well, you bought more of it.
I did.
I mean, you're laughing all the way to the
I know.
buy more button.
Yeah, well, I had to. It's down 12%. I mean, I think it's an overreaction, but you can't miss in this environment. The stock is up 40% from the October lows. So they missed earnings, they missed revenue, but I still like what they're doing in services. I think their book to bill being over 1 is good. Orders are still there. They did see some volumes softness in imaging and ultrasound. I think that's going to come back. So the problem is now their guidance, which they reiterated, it's like back half loaded, and no one likes that. But I do think that this company is really set up very well over the next several years. So that's why I'm adding to it.
Okay, you bought more 3M as well.
I did. I think that stock should be up a lot more. I mean, earnings were up 17%, operating income up 22%. Their margins were up over 300 basis points year over year and handedly beat the street. So to me, I think this is just the beginning. Bill Brown starts tomorrow. And so then now you have a great leader with a proven track record at L3 Harris. When he was at L3 Harris, the stock rose over 400% in a 10-year span. So I like it very much.
It reminded us of just how well some of these spin-offs have done, these spin-off success stories, what we're calling it. Our chart of the day, I want you to take a look at the spin-off index, the ETF that tracks this. From the October low, October 27th to today, up 31.5%, dominated by industrials.
Yeah.
No big surprise, right? Vernova, GE Vernova, that was obviously spun off from GE. Veralto spun off from Danaher. You've got GE Healthcare, we just talked about. Solventum spun off from 3M. You have others on this list. Why is this working so well? Industrials, by the way, have an index weighting of near half.
Yeah. I mean, spins definitely work. It unlocks value. You have the management team that's 100% focused now on the one business, not 3 or 4 different businesses. And the interesting thing is you actually get the proper sell-side analyst coverage because when GE was covered by the industrials, the healthcare piece and the power and the renewables business got ignored and was underappreciated. And so when you spin them out, you can actually focus 100% of your attention. By the way, one of my very best spins was Zoetis. Remember back in 2013, they spun out from Pfizer. The stock's up 500% since then. It's not been a good stock this year, but it's been a great spin.
The other breakdown, well, speaking of Zoetis, I mean, if you want to put healthcare is 15% of the index weight. That's second. Technology is number 3. Josh, how do you think about spin-offs and whether they're going to be successful or not, whether it's a reason to buy into a name?
So I think I think it's an individual story dependent thing, but the premise of the spinoff, Stephanie is absolutely right. The academic literature is pretty clear. The thing that's really interesting is very often the best approach is to hold both the parent company and the spinco and not choose between the two, because then you have 2 focused management teams. And then you often, so we focus a lot on the baby, but oftentimes the parent becomes unencumbered. Much like my wife and I in July when our kids are at summer camp. So I feel like when you have a spin-off and a lot of spin-offs happening in the sector, we've seen this in energy, we've seen this in industrials and healthcare. Oftentimes there's just a refocus happening, and you want to keep both pieces. And I've seen that work very successfully. As far as just buying the spincos, though, Scott, I think you want to know what you're buying, and you know they're obviously always different situations.
You know, the other just reminded me as we're having this conversation, Steph, is you own IBM. You did not buy Kyndryl, though.
No, I didn't.
Why?
Sorry, I didn't
really
see
like
your
the
comment.
business, I mean, it's been not a bad stock, but I just didn't like that business. I just liked the fact that IBM was just getting smaller, shrinking.
Sorry, I didn't have the
I
mic
just
on and
preferred it, so I
stuff.
put all my money back into IBM.
I just care more about, more so inflation than just the idea of someone else taking from you or me or someone else, whether because you made more money or because you didn't make more money. This Russia-Ukraine stuff is not our issue. It's not my problem. It's not you. They got themselves into it. They need to figure out what they got to do to get out. Instead of just taking from people. That's all they want to do. take. For 4 years, they've been coming up. Where can we take? Where can we take? Where can we take? Just to take more and more and more and more from everybody. Like literally, they do things like you transfer $600, you got the IRS knocking at your door because they want to know if you got to pay taxes on that $600 that you gave your daughter to go pay rent or someone else. Or it's sick. It really is. It's just gotten really out of control. And I'd much rather them not spend money than to do all this shit. It's crazy. And they're going to mess it up.
Our team of passionate traders, ready to help tackle anything, from the most complex trading questions.
I was getting a little tired there. I might go get something to eat. I got some chicken in the fridge. I'm going to grab it. Appreciate you guys being here. Hit the like button if you want. Maybe something sets up this afternoon. I'm not sure what I'm going to do. If I should just take the rest of the day off. The electric went out earlier. I don't know. We'll see what the afternoon brings. We'll see if we get some small caps and some news or something.
Saturday.
Keep an eye on the markets this final trading day of the month of April, shaping up to be a difficult one. Dow's down about 400, S&P 500 down about 45 points. That's less than 1%, obviously on the S&P. But we'll continue to watch that as we do our calls of the day. Live Nation, Josh, initiated by Deutsche, price target 120. That's 30% up from here. Stock reports on Thursday. It is having a terrible month. It's the worst one since September of 22. Why?
It's down about 10% since the Wall Street Journal reported on an investigation or whatever's going to happen. The analyst agrees with what I think here. I'll just quote what they're saying. We believe the most likely outcome of a potential regulatory investigation will be pro-consumer reforms, which shouldn't be materially disruptive to Live Nation's business opportunity, and not a more drastic structural remedy. So you have a company that's going to deliver double-digit earnings growth for as far as the eye can see, a one-of-a-kind asset. It's really a jewel. It's an area of entertainment and leisure that they are the best player, the best possible way to invest there. and they are a very high level operator from Michael Rapino all the way on down. So I'm a long term investor here, and I think the stock under $100 is a gift.
Okay, Jimmy, Citi was called the favorite stock in Oppenheimer's Q1 2024 bank review today.
I feel like that's been happening more and more in the past 6 months or so, that more and more banks are getting behind Citibank in terms of research coverage and believing in it. And I think it should have happened a long time earlier. The company is clearly streamlining itself, pays a nice dividend at about 3.5%, buys back shares by the ton at 70% of tangible book value. And Jane Fraser, the CEO there, has had a credible plan for over 3 years. It's just now being recognized. I think there's more room to run.
Let's debate Boeing with you guys. Downgraded today at Argus, okay? We know about the troubles that the stock has had. Steph, you own it, okay? Jim, you did own it. You did love it. You sold it, and you wouldn't touch it. Steph, about this call. It's down 30% year to date.
Oh, yes, I know. I definitely know. And
Sorry to have to remind you that.
I've been saying for a while it's dead money until they hire and make the announcement of the CEO. In the meantime, I'm thinking longer term. They have 5,600 planes in their backlog, valued at $450 billion, up $7 billion from last quarter alone. They will get through the 737 MAX issue, and when they do, they will eventually get to 50 planes produced a month. It's going to take some time, but I'm sticking with it because it is down so much. And oh, by the way, it was really interesting yesterday. They had a $10 billion debt deal that was 8 times oversubscribed yesterday. That was announced. That's why the stock was up 4%. So it's not going to take much.
Okay, so Steph, I mean, you know how I feel about the company.
Said 504. There's our 504.
To exist. The government knows it. The airlines know it. The nation knows that Boeing needs to exist. My concern here has been, since the Alaska Airlines disaster, is that the government's going to have to step in here to really get their operations on track. I hope I'm wrong. You know I hope I'm wrong. But I'm worried the government's going to have to step in here and basically say, to hell with profits. We need Boeing to work, period.
I feel like they already are doing that. That's why they can't get back to 38 planes a month. That's why they delivered like 3 last month. So I think it's going to take some time, but I think eventually it will happen.
All right. Well, you've had patience with some other stories that have been taking a little time, and they've worked. Patience is a virtue. You ever hear that?
Oh, yes, I have.
All right. Still ahead, we're trading some of today's big earnings movers beyond Amazon and AMD. And Mike Santoli's on the other side of this quick break with his midday word. Our senior markets commentator Mike Santoli here for his midday word with the Dow now down about 423. I guess we've had too many sticky inflation reads for comfort at this point, and this is part of the reaction.
It's part of the reaction, and therefore the Treasury market continues to test the equity market. I think that, when it comes to actually what Powell says tomorrow, everyone's pretty hawked up already. I mean, the numbers tell you should be in a way, that there's not met the threshold for greater confidence that inflation is heading toward target. On the other hand, there's no dot plot to have to explain away, right? So we don't have that this meeting. He can kind of take whatever stance and say he's data dependent. We already kind of know what the data are. So that tells me, I'm not sure there's a ton of surprises, but the numbers are what they are, which is you can't quite be comfortable, even if we talk our way around some of the extraordinary items, about the inflation side. So it's static. It's good growth. Its earnings are coming through fine. And it's what do you pay for them in this environment at this point in the cycle?
The bulls cannot leave the meeting tomorrow even thinking about a hike. That fully upsets the story. I mean, we expect hawkish, at least a hawkish tilt.
Yeah.
But if he goes there, we probably have a problem.
It's a question of how he goes there. Is it an acknowledgement that the risks are balanced on either side, and who knows what the data are going to tell us to do? Fine. I don't think he's going to fully withdraw this idea that he believes rates are restrictive where they are relative to where they think neutral is. That would be a big surprise. If he basically says, listen, this economy is impervious to 5.25% Fed funds, and therefore we have to go higher, I doubt he's going to say that.
Sure, but irrespective of what all of the other Fed speakers since the last meeting have said, he's the one who has repeatedly made you believe that they're done, right?
Sure.
They're done.
Well,
Their
the way
next
you
move's
say
a
you're
cut.
done is you say we still believe policy is restrictive, and it'll be appropriate to normalize it at some point. It's going to be that kind of Fed speak. I really think the market most wants to get through it, and then figure out where we are in terms of tabulating the earnings picture, and then on a tactical basis, we got this bounce. It failed right at the 50-day average, and now the sellers are going to come out and say maybe there's more to be done here on the downside.
See what it looks like when I see you on closing bell. Look forward to that. Mike Santoli joining me, of course, at 3 o'clock. Coming up, we're going to set you up. We got a lot of stocks on the move today. Owned by the committee. There's NXP, we got Eaton, we got Rig. We'll trade all those next. right, some committee stocks on the move today. NXP, they beat. Jimmy, you own it. You trimmed it a couple of months ago. We can take a look at the performance of the stock. There it is. It is up 1.75%.
This has been a little unsung darling in my portfolio for several years. Having said that, the earnings report wasn't a blowout. It just wasn't a blowout. The guidance was okay. It was kind of in line. And they're pointing to a second half recovery in the auto sector in particular. Obviously, expectations were very low here with what's going on with Tesla and other electric vehicle manufacturers. I think, though, that this is getting a little long in the tooth for me. I'm having a hard time saying that, but it's getting a little long in the tooth. So I did trim it a couple of months ago. It may not be long for my portfolio.
Wow. Okay. You keep us up to date, please.
Yep, I will.
Eaton, Stephanie Link, new all-time high today. Take a look at that stock as we throw it to you.
And it's reversed. I think it's
Oh,
just
it's reversed.
Yeah.
Why is it reversed?
I think it's just selling news. I mean, the stock's had such a nice run. It's not cheap by any means, but they really did have a very good quarter. Electrical ran the show, if you will, up 17%. Aerospace up 9% in sales. Really solid results from those two big parts of the company. Margins up 630 basis points, talks to price mix. So if it continues to pull back, I will be adding to it.
Jimmy, you want to take on RIG, Transocean?
Yeah.
Better than expected loss.
Yeah.
Right? Revenues missed.
Yes, and an EBITDA beat, which is what you're really looking for. So why is the stock down 11%? I talked yesterday about the fact that we need these idle rigs to come back online in active contracts. That is actually on track, but clearly people were hoping for it to happen a lot sooner than it looks like it's going to happen. Here's what the company said on the call. The active fleet for the entire industry is going to be all used up, all contracted out by the end of the year. And then there will be calls on those idle rigs. They said, we're not going to be the first to go. We're going to hold out for the higher price. That's what they've always done. Just be a little patient here. This 11% decline is way overdone.
Hey, Jim?
However, yes, Josh.
Why wouldn't they do a reverse split? Why are they allowing this stock after it's been a penny stock for 5 years? What are they thinking?
I think the answer is it's so darn volatile, Josh. I mean, it was at 8, it's at 4, now it's at 5 and change. I think they're thinking it's going higher from here. Maybe they're wrong, but I think it is going higher from here.
This stock has been I think this stock for 7 years now has been under 10.
Yeah.
It just seems like very unshareholder friendly.
Just to be helpful, Josh, really quickly.
Curious.
Just to be helpful really quickly, go back to before the pandemic. They are approaching those financial numbers in terms of revenue and income, and the stock was above 10 then. I'm not arguing with you. I'm just saying, like, it should be higher.
Okay. We'll take a quick break.
I feel you.
Yep.
Finals are next. Okay. Jim.
Empty.
Stephanie Link.
Raytheon.
Josh. No Josh.
Amazon.
No seat. No one there. See you on the
Amazon.
bell. I'll see you on the closing bell.
Welcome to the Exchange. I'm John Ford in for Kelly Evans. Here is what's ahead. We're just a little more than 24 hours away from the Fed's next decision on interest rates, and one of our guests says we could be in for a hawkish surprise. She's here to tell us what she means by that, and we'll look at how to position from here. Plus, here comes Amazon. Expectations are high, and that's okay, says James Cockmack, because the tech giant is firing on all cylinders. He is here with what makes him so bullish into this print. And this name just delivered a solid quarter, strong guidance. The stock is up 3% at all-time highs, but it's a crowded space. The closest competitor just entered the public markets. The CEO, though, is not worried, not pulling any punches either. He's going to join us live and exclusively ahead. But we begin with today's markets. Dom Chu has the numbers. Dom.
It's red, John, and it's getting a little bit worse. We're right now just near session lows right now. And the Dow Industrials, that means a 414-point decline. That's 1% to the downside, 37,971. The broader-based S&P 500, 5,065 the last trade. They're down about 50 points, about 1% as well. And to give you some perspective, at the highs of the session, we were still down, albeit just 6 points, and we were down roughly 53 points at the lows. So again, hovering right near the lows of the session right now. The NASDAQ Composite Index, broadly in line, all but down about 1% or so, 185 points to the downside, 15,798 the last trade for the composite index. Now, John mentioned that big technology trade. Amazon is going to be the big focus because of the earnings report after today's close. We'll put a big circle around that 1% decline for Amazon shares right now, currently down $2. But broadly speaking, big technology, Microsoft down 1.75% here. Apple, the standout to the upside, it's actually up 0.1%. Nvidia down 1%. Alphabet down 1% as well. So that mega cap technology trade, it's usually Nvidia the one that we're highlighting as the upside mover in that kind of broader base decline. But keep an eye on Apple. Interesting move there to the upside and an otherwise down tape. And then the stock of the day, the industrial conglomerate that's now two different companies, Solventum and then the parent company, formerly 3M. It's up 3.5% on an earnings and revenue beat. Generally speaking, a good quarter for the industrials company after spinning off that healthcare business. They're going to cut their dividend. Not a surprise for a lot of folks out there when you cut off a big part of the company. Cash flows change, the dynamic of the business and balance sheet change. So they're going to cut the dividend after paying an increasing one for 64 straight years. They paid a dividend of some sort for about 100 years at this point. But 3M, some analysts and some investors think that maybe this could be the turnaround story. This could be something happening in the works. Positivity there. We'll see if it sticks around for 3M shares, John. Up 3.5% in a down tape. I'll send things back over to you.
All right, Dom, thank you. Well, it's not just the Fed officials who've taken a more hawkish tone as of late. Respondents to the CNBC Fed survey have as well. So let's get to senior economics reporter Steve Leisman for more. Steve.
Hey, John, yeah, the outlook on the survey has turned more hawkish along with markets, with respondents delaying the bulk of rate cuts in the next year amid a forecast for higher growth, but also higher inflation this year. Take a look at the numbers here. Only one cut now fully priced in for this year, and that's in December. They're 48 on September, and that was compared to June being the pick in the prior survey. The group split, of course, on the possibility of that September cut. The 29 respondents see a 22% chance of a hike in the next year, 3.8% funds rate in 2025. So still cuts in the forecast, but now next year and a bit less than had been forecast. That neutral rate ticking up by 0.2 in the survey, suggesting the Fed is maybe not as tight as previously believed before the when the Fed started hiking. The current, you can see right there, follow the blue bars for the current forecast. All of that's up from the yellow bars from the prior forecast by a cut or two, but it adds up over time. You can see there now 3.8% is seen as the neutral, is the next year's number. The neutral now 3.1 versus 3.3. Peter Bookvar from Bleakley Financial, he writes in, I think the bond market now has it right that maybe we'll get one cut this year with a slight possibility of two. That's more or less how the market is priced right now. Survey respondents actually somewhat more hawkish in the futures market, in part reflecting those forecasts for better growth, but also higher inflation. And that comes with a growing belief and debate right now about whether the economy has to slow down and unemployment has to rise for the Fed to hit its 2% inflation target, John.
Steve, chance of a hike there at 22%. Is that much of a change from what we saw earlier?
Well, we didn't ask that question before, John, because there wasn't really much of a hike on the table. The Fed's bias was to cutting, and hindsight's 2020. We wish we'd asked it before, but we asked this time by itself. What is the probability that the Fed reverses course and hikes rates? I guess you could think of that as some possibility that Powell tomorrow, or in some speech down the road, if these inflation numbers keep going the way they are, that Powell introduces some two-sided risk to the direction of rates.
Huh. Okay. Well, listen for that. Steve, stick around. Our next guests say we could be in for a hawkish surprise from Powell tomorrow, speaking of. And that poses the biggest risk to the markets right now. Joining me now are Paul Christopher. He's head of global market strategy at Wells Fargo Investment Institute, and Stephanie Roth, chief economist at Wolfe Research. Welcome, guys. You're both,
thank you,
Paul, expecting more than one cut, unlike sort of the median in this survey. 3 still? Well, only 2 in 2024.
Only
2
2
in 2024. Yeah. Okay, 2.
Yeah, and 2 for us as well.
Okay, so Paul, talk through the risks here and how much your probabilities have had to shift as this data has come in.
Yeah, the Fed they'll always tell you that they're watching data, so the risk is to the downside on cuts for this year. But we really believe that inflation will start to resume its downward march, the disinflation. It's just been sticky for a while. That's not unusual for inflation over time. And we think as inflation falls, the economy will slow modestly, and that will give the Fed enough of a window. We think somewhere between 2.5% and 3% inflation, the Fed will cut. And then we'll start to see some of those borrowers who've been constrained by Fed policy, but not by, let's say, availability of other sources of credit, people like consumers, small businesses, regional banks. They will have better access to credit, and that will help really push the economy forward at the end of the year.
And Stephanie, you expect that as we start to get April data over the next few weeks, this narrative is going to shift. What are those key moments you think that'll make the difference?
Yeah, and what we've seen is a lot of the data in Q1 have been subject to a lot of seasonal volatility. And today's ECI is just another example of that. It was seasonally depressed in Q4, seasonally boosted in Q1, and then in Q2, you should start to see a normalization from that perspective. So the first print that we might see will be on Friday, and that's one of the most important April data points that we'll be getting on payrolls. We actually think the payrolls number could come in fairly firm, but on wages, we're looking for a bit of a mess. We're looking for 0.18% versus consensus of 0.3%, and that can kind of kick off the start of some of the more dovish surprises. On top of that, the housing data should start to soften a bit as financial conditions have tightened more recently. And then on top of that, when we're getting the CPI prints and the PCE prints starting April and looking forward, they should start to come in a bit cooler. We think that the trend in inflation is somewhere closer to 2.5%. It's been recently held up by seasonal volatility, and that goes the other way starting in April.
Steve, how much relative attention does go to the wage data on Friday and maybe even to revisions?
You know, a little bit less than people think. This morning was the important wage data for the Federal Reserve. Powell has made clear, and I think it makes a lot of sense what he's done, is really shift the focus to the employment cost index, which is sort of an all-in indicator of benefits and wages, as well as being not really corrupted by the constituents of the wages of the employees in there. It's just, it's a better way of looking at it, and it was higher than expected. I hope Stephanie's right about the wage data on Friday, and there's a whole lot of other inflation related data we'll be following. The participation rate, are we still getting influxes into the workforce? But I think the unemployment rate is the one to watch. If you want to think about rate cuts this year and multiple rate cuts, I think it may only come with the development of slack in the economy. And that slack in the economy, John, I think is going to mean an economy that runs below potential and one where the unemployment rate is seen rising. Maybe not precipitously, but enough to say, you know what, we're going the other way on unemployment here.
Paul, you like energy, materials, industrials, and healthcare in this market. Spend a little time on healthcare. What in particular is important there? We just had Lilly report. What names are you watching closely to see how it's playing out?
Well, we like all of those sectors that you mentioned. For longer term investors, our clients are primarily long term focused, and for the long term, we think the pandemic demonstrated really that the capacity, the healthcare capacity in this country, is not where it needs to be for another kind of that event. And so we do look for more public spending, more private spending. Managed care would be a focus for us going forward, less so pharmaceuticals, maybe devices, maybe more neutral there. So that's kind of our way of thinking about healthcare.
Are you looking for upside in particular sectors, Stephanie, or just looking at the market overall in general? We had somebody on CNBC a couple days ago say, don't try to play particular sectors.
Yeah, I mean, we're definitely optimistic on the economy as a whole, which should then lead itself to sort of higher earnings this year. But I'm thinking from a sector perspective, things related to the industrial cycle should do fairly well this year. We're having a bit of a bottoming in the manufacturing PMIs, and we'll see some more details on that tomorrow. But the trend we think is positive. On top of that, you have a decent amount of infrastructure spending. A lot of the public spending starts to roll out this year. And then you're actually getting a bit of a loosening in financial conditions, at least compared to where we were a year ago, and a better optimistic outlook when you're thinking about the chances of recession. So companies are going to be a little bit more interested in doing capital spending, which should support the CapEx side of the economy. So generally speaking, it's some of the more cyclical sectors of the economy that we do like here, at least when we're thinking ahead to the next 6 months or so.
Steve Leisman, there's been some reticence on the part of businesses to borrow money and spend. How closely is the Fed watching that?
Part of the outlook for sure. I think they would like to see a little cooling in that market. It's very interesting to me, John, that we've seen a kind of a little bit of a renaissance in IPOs. It feels like that there has been some loosening of financial conditions. Remember, we're not that far off the high, so equity financing is actually relatively cheap. The higher the market is, the cheaper that financing is, while debt financing has remained relatively expensive. So what we might be seeing here, John, something worth talking about, and Bob Pisani has been all over this little IPO boom that we've had here, or at least a return to maybe more normal numbers, is that people are preferring equity to debt because of the price of debt, with the question being whether or not those rates are going to be coming down. I think it was an expectation of a lot of CFOs at the beginning of the year that, well, this would be a good year to maybe go and refinance because debt yields are going to come down. While spreads may be relatively tight, actual yields have not fallen very much and even gone the other way. So there might be a preference out there for equity right now, given that the market is off less than perhaps yields have risen.
Interesting. Okay, Steve, thank you. Also, thank you, Paul Christopher and Stephanie Raw. Well, turning to the housing market, where demand is still strong, even in a higher rate environment. Home prices on a tear again. Diana Olick joins us with the latest. Diana.
Well, John, strong demand and tight supply just continue to push home prices higher, even though mortgage rates are now moving higher again. Home prices in February jumped 6.4% year over year. That's up from January's increase of 6%, according to the S&P Case-Shiller National Home Price Index. It was the fastest rate of price growth since November 2022. Now, after cooling last year, home prices are again near all-time highs nationally and already there in certain markets. For the third straight month, all 20 cities in the index saw annual increases, 4 of them at those all-time highs. Those include San Diego, Los Angeles, Washington, D.C., and New York. San Diego saw the biggest gain overall, prices there up 11% year over year, followed by Chicago and Detroit, which both saw nearly 9% price gains. Portland, Oregon saw the smallest annual gain, up still, though, just 2%. Important to note on this report, though, it is a 3-month moving average, so it goes back to December when mortgage rates hit their recent lows. They are, of course, way back up again, now over 7.5% today. There was also a strong expectation back then that the Federal Reserve would lower interest rates, and that may have driven buyers to jump in then, pushing prices higher. As we know, John, that is not the case now.
No, very much not the case. We also saw some strong earnings this morning from Taylor Morrison. It's one of the nation's largest home builders. How did that really pan out given this higher rate environment?
Yeah, it was not only a nice beat, but they also raised guidance. And it's because home builders have a big toolbox in order to get those buyers in the door. And Taylor Morrison actually reported a big jump in first-time home buyers. And what they're doing is they're helping to either buy down the mortgage rates or use other incentives that help those first-time home buyers get in the door. One thing that Taylor Morrison's CEO, Cheryl Palmer, noted on our air this morning is that she doesn't expect prices to come down much. In fact, in 60% of the sales, they did see price gains on those sales, as well as smaller incentives. So the builders are in the hot seat because there just isn't enough supply on the existing side, and that supply is just not coming on the market now. Sellers are still stuck with their 3% rates, so the builders are sitting pretty. They're able to raise prices as long as they can get those mortgage rates down a bit.
If you are a young person, young professional entering the market right now for so many things, it is just tough. Any sense of when people might be forced to sell and open things up? Because we've been talking about that for a while. It hasn't happened.
Look, there are always life circumstances that make somebody have to sell. There's either a death in the family, there's downsizing, there's a divorce, there's a job change. There are just regular life reasons that people have to move. It's just that we're not seeing that move up buyer who normally fuels the market from that entry-level home into the step-up home. That's what we really need to see. And the reason that's not happening is, again, because they have rock-bottom mortgage rates and because the step-up home, the move-up home, is so expensive right now.
Yeah, I don't know how that gets solved. Diana Olick, thank you. Sure. Coming up, the expectations for Amazon's earnings, well, they could hardly be higher, according to one portfolio manager, but he says the company is firing on all cylinders and sees the stock rallying 25% from here. He's going to join us next to make his case. Plus, Fidelity's cloud computing ETF is on pace for its worst month since September 2022. But one name in the group is hitting an all-time high today on the back of an earnings beat. We will speak with the CEO exclusively ahead. And Tilray, surging in the last few minutes as the DEA reportedly plans to reclassify marijuana as a less dangerous drug. That is according to the Associated Press. The exchange is back after this.
This is The Exchange on CNBC.
Humanly possible.
Capital spending among the mega cap tech companies now surging as Microsoft, Alphabet, and Meta all outline plans for tens of billions of dollars in AI investments. So what's in store for Amazon as it gets set to report tonight? Well, Deirdre Bosa is looking at that for today's Tech Check. Dee?
Hey, John, we are in the midst of a new CapEx super cycle driven by what Jensen Huang calls the AI computing ramp. And this chart that I'm going to show you really puts it in perspective. It shows CapEx spending and forecasts among the biggest players ex Amazon, which reports tonight. So for 2024, spend was expected to grow 26% year over year collectively, the orange part of that line. But look at the yellow part. That's the revision. It's been revised up to 44%, getting closer to the last super cycle around 2018. Now I want to show you what it looks like when you overlay revenue growth. Again, ex-Amazon, it's not even close to keeping up, and it's less than half what it was back in 2018 when the mega caps were growing at a much faster clip. It's been revised up this year by just 3 percentage points, sure, but that is really a drop in the bucket versus the 40% plus CapEx growth. Now, what does help the case, particularly for Amazon, is profitability. It is expected to have spent more than anyone else this past quarter on CapEx, but its gross margins and its net income have improved significantly under Andy Jassy's leadership, even leading to increased expectations for a dividend, which could soften the blow of higher spending like it did for Google earlier this week. And it's just Amazon and Tesla now, John, without capital return programs, so perhaps the pressure a little more intense on Amazon, particularly because it can afford to give capital back to investors.
Well, I guess in a way it makes sense that the AI spending is ramping more than the revenue. I mean, you usually have to invest before you get paid, but I guess this also underlines the strategic imperative of investing in these custom chips because they hope to be able to offload more of those AI workloads over time, not necessarily use as many NVIDIA chips and perhaps use their own, right?
Which are scarce and more expensive, right? So that's why you see Amazon, Microsoft, Alphabet developing their own chips so that it can take some of that workload, but that demand for the NVIDIA GPUs still extremely high, and that's keeping costs up. But you're right, John, it's all about the future trajectory, and that revenue is expected to ramp later, so they're putting in the investment, similar to what Amazon did to become so profitable now. Remember, it doubled its logistics capacity over the pandemic, and now it's really reaping the rewards of that.
You get any sense of whether the expectations or the bar set for AWS shifted after the strong cloud reports from Google and Microsoft?
I mean, you know as well as I do, a larger base to come off of, right? But I think that we're in this sort of new era of the cloud wars, right? Where it's what can you offer in terms of AI tools? And Amazon has been trying really hard to say that they give their customers a ton of options. Certainly, investors want to see that AWS growth grow bigger, but it's certainly smaller than what we've seen, smaller in terms of growth on a percentage basis than what we've seen from Microsoft and Google. But I think it's got to be over that 14-15% level.
All right. Dee, thank you.
Thanks.
Well, let's look further into Amazon. The street's expecting big things from the tech giant's Q1 results, including AWS revenue of $24.5 billion, which would be the segment's best growth in 4 quarters. Our next guest says the stage is set for Amazon to deliver. Let's bring in James Chuckmuck, Clockwise Capital Partner and Portfolio Manager. James, you're confident that Amazon's going to do what it has to do here. How much of that has to do with the overall cloud market strength that we saw from its competitors?
Yeah, I'm as confident as you can be in this tape. I think it's great the fact that they're reporting last, so a lot of those expectations have been reset. But I think what Amazon has going for them now is that a lot of these Mag 7 names are coming off really great rates of growth in 2023 and are starting to, where those growth rates are starting to moderate. Whereas Amazon suffered in 2023 with the optimization efforts and tough comps on retail, where they're on the upward trajectory in terms of estimates go. So, we're still in the early days as far as the efficiency efforts on the retail front. The cloud spending is starting to ramp at a more meaningful way with the optimizations behind them. And most importantly, as Deirdre also pointed out, on the margin, those efficiencies will trickle down. And for the first time, we're going to be able to start to value this company in a much more meaningful way on an earnings basis than just on a sales basis.
There's a narrative for much of last year, and Microsoft did a good job fueling it, that Google and Amazon are behind, like way behind in AI. Anything Amazon can do on earnings to counter that?
Well, I mean, Andy Jassy pointed out this morning on a tweet that the AI efforts and developments that they're making for tools for developers. So I think a lot of the AI efforts that you're going to see out of Amazon are going to be more behind the scenes with the developers utilizing it, as well as on the logistics and fulfillment and the network and the predictive analytics on the consumer side. So a lot of behind the scenes stuff that I think will trickle into higher conversion rates and higher utilization of the platform. And that will help produce more sustainable rates of growth as we go forward.
Now, away from AWS, whether we're talking about delivery efficiency or advertising performance, are there things that investors might not be looking at as closely that could provide upside that would move the stock?
I think a lot of it's well appreciated at this point. We know that AWS is marching back toward that 20% growth rate. Advertising is certainly becoming a big, meaningful part of their business. They're a top 5 advertiser right now in terms of dollars, and the margin as well. So a lot of it's appreciated. I think what it will come down to is just further reinforcement that the trends are intact. And if that's the case, I think that the stock should continue to propel higher, because as we see from some of the other Mag 7 names like Netflix and Meta, with moderating growth rates, you want to be on the right side of that mean reversion and not on the wrong side. And I think Amazon is positioned well for that.
Does Amazon need to offer a dividend?
It certainly would be nice. I mean, you saw what it did to the Alphabet stock. So, I mean, I'll take a dividend anytime it's offered to me.
Yeah, they like to spend that money, though, right? Invest it, and others, including Meta, are spending also. I just wonder if, because Amazon is the type of company it is, with real sort of both bits and atoms in its product line, if they get a pass to some degree from offering a dividend, because we know that they go through these investment cycles.
Well, I'll just say, I think that when it's clear to them, I mean, I'm assuming that this is the logic that they'll have because of the pedigree and the mindset of management that we've known for years now, is that as long as that there is absolutely no trade-off between growth initiatives and returning capital to shareholders, I think that that's something that they'd certainly be open to, because they are a free cash flow oriented business. So if that trade-off is not there at the expense of growth, then I certainly think it's something that could conceivably be on the table. But if it's still, if it's an adverse, counter to their initiatives, then I don't think that we'll see it anytime soon.
As we head into the back half of the year, what's the line that strategically becomes most important or more important to you? Does it have to do with the lead up to AWS reInvent and some of the setup on the AI message, or does it have more to do with the continuing ability of the consumer to show up and keep fueling the core e-commerce business?
I hate continuation stories because they're boring. You don't really have a big catalyst. But I think, unfortunately, kind of Amazon falls into that bucket. But I will say the main thing I'm going to be looking for is that AWS growth rate marching back up to 20% in a reliable way. And further to that, are the incremental margins of the AWS business going to go back toward that 50% incremental margins that they were posting during the couple of years prior? So, as long as those things move in the right direction and you continue to see the efficiencies on the retail side and the optimization on their fulfillment network, it's going to be a continuation story. This is a grind higher stock, and that's the way that we're playing it. I mean, I don't think it's going to be whippy, in the same manner in which we saw Meta, Netflix, and whatnot. I think it's going to, just like Microsoft, it'll grind higher.
All right, we've got to look at those numbers in overtime on CNBC, 4 p.m. Eastern. James Truckmuck, thank you. Now coming up, Warner Brothers Discovery hitting its lowest level since March 2009. We're going to tell you what's weighing on those shares next. And as we head to break, here's a look at the best and worst performers in the NASDAQ 100 this month. AstraZeneca leading the way, up 12% in April, thanks in part to last week's big earnings beat. On the flip side, Intel is down 30% in April, following Friday's 9% drop after the company gave weak guidance for the current quarter. Exchange is back after this.